Most people spend their entire career trying to beat the market. Most people fail. And the ones who win quietly, the ones retiring with over $1 million, are not doing what you think. They are not picking the right stocks. They are not timing market dips. They are not working with expensive financial advisors. They are putting money into one boring fund every single month. And then they leave it completely alone. The S&P 500 index fund is the most unsexy investment in the world. It is also the one that has consistently built more millionaires than anything else. And by the end of this video, you will understand exactly why. I'm also going to show you a side-by-side comparison later. An active stock picker versus a passive index fund investor. Same starting capital, same time horizon, completely different outcomes. Stay until you see those numbers. Let me start with a question most people cannot answer. What is an index fund? An index fund is a single investment that buys every company in an index. An index is just a list of companies following a set of rules. The S&P 500 index tracks the 500 largest publicly traded companies in America: Apple, Microsoft, Amazon, Nvidia, Berkshire Hathaway, all 500 of them, inside one fund. When you buy one share of an S&P 500 index fund, you own a tiny piece of all 500. When Apple goes up, your fund goes up. When Amazon grows, your fund benefits. When one company collapses, the other 499 absorb the impact. You are not betting on one company. You are betting on the American economy as a whole. And historically, that bet has never lost over any 20-year period in recorded history. Not during the Great Depression recovery, not after the dot-com crash, not after 2008, not after 2020. Over every rolling 20-year window in modern history, the S&P 500 has delivered positive returns. That is not a sales pitch. That is the historical record. Now, let me explain why most people ignore this, because it sounds too simple. When you hear, just buy an index fund and wait, your brain resists it. It feels like you're not doing enough. Financial media does not help. CNBC runs headlines about which stocks to buy right now. Reddit threads argue about the next 10-bagger. YouTube channels show screenshots of massive single-day gains. All of it creates the impression that successful investing requires constant activity. It does not. Active management consistently underperforms passive index investing over time. Not sometimes, not in bad markets, consistently. A 2022 S&P Global Report found that over a 20-year period, 95% of actively managed large-cap funds underperformed the S&P 500 index. 95%. The professionals, with Bloomberg terminals, research teams, and decades of experience, still lost to the boring index fund the majority of the time, and they charge you fees for losing. The average actively managed fund carries an expense ratio of around 0, 7% per year. That sounds small. On a $500,000 portfolio, it is $3,500 per year in fees. Over 30 years with compound growth, that fee difference alone costs you over $200,000. You paid $200,000 in fees to underperform the index. The index fund does not do that. Vanguard's VFIAX S&P 500 fund charges 0.04% annually. Fidelity's FXAIX charges 0.015%. Fidelity's FZROX charges 0.00%. Nothing. Zero. Not a single dollar in annual fees. The boring fund wins before the market even opens. Now, let me introduce you to Alex. Alex is 32 years old. He works as an engineer earning $88,000 per year. Alex is not a financial genius. He does not read earnings reports or follow technical charts. He opens a Roth IRA through Fidelity. He puts $500 per month into FZROX, the Fidelity Zero Total Market Index Fund. He sets it to auto-invest on the first of every month. He does not check the balance after every market move. He does not pause contributions when the market drops. He does not sell when the news gets scary. He does not do anything except contribute $500 every single month. He does this from age 32 to age 65, 33 years. At the S&P 500 historical average return of 10% per year, Alex ends up with $1, $97 million, nearly $2 million from $500 per month in one fund, with zero stock picking. Alex is not lucky, he is consistent. And consistency applied to compound interest over decades is the closest thing to a guaranteed wealth formula that exists. Now meet Kevin. Kevin is also 32, same income as Alex, same starting capital. Kevin wants to do better than average. He picks individual stocks. He follows influencers. He watches market news daily. He buys Tesla, Nvidia, and a few speculative tech names. Some years Kevin does well. In 2021, he is up 34%. He tells everyone at the dinner table. He opens a brokerage account for his sister. Then 2022 hits. Kevin loses 41% of his portfolio. 2023 recovers partially. 2024 is mixed. Over 33 years, Kevin's average annual return is 8%. Some great years, some catastrophic ones. By 65, Kevin has $840,000. Alex has $197 million. The difference is $1, $13 million. Alex did less. He earned more. He stressed less. He retired richer. Kevin spent 33 years actively managing a portfolio that earned him $1, $13 million less. That is not a unique story. That is what the data shows for the overwhelming majority of active investors. Here is something that surprises most people when they first learn it. The S&P 500 has a built-in survivorship advantage most investors never consider. When a company in the index starts declining, it does not stay there indefinitely. Once it drops below the size threshold, it gets removed and replaced. Sears was once a top S&P 500 company. It is gone. General Electric was once the most valuable company in America. It dropped out. The index replaced them with companies that were growing. You, as an index fund holder, never had to make that call. The index committee made it automatically. This is the invisible portfolio management that makes passive investing so powerful. No individual investor consistently makes those replacement decisions correctly. The index does it by design, every quarter, without emotion, without ego. Now let me address the most common argument against index funds. People say the S&P 500 is too concentrated. The top 10 companies now make up over 35% of the index. Apple and Microsoft alone represent around 14%. Is that a valid concern? Partially. Concentration risk is real. But here is what that argument misses. The S&P 500 rebalances automatically. Companies that grow become a larger part of the index. Companies that shrink lose their weighting. Companies that fail get removed. In 1980, the dominant companies were energy giants and manufacturers. IBM and Exxon led the index. By 2000, it was Microsoft and General Electric. By 2024, it is Apple, Microsoft, and Nvidia. The index always holds whatever dominates the American economy at any given time. You do not need to predict which companies will lead in 2040. The index automatically finds them and holds them for you. That self-correcting mechanism is one of the most underappreciated features of index investing. Here is something else most people get wrong about index funds. They think they should wait for the right time to invest. They wait for a market correction, or a crash, or a more stable environment. That waiting is one of the most expensive habits in investing. Let me show you what it costs with real math. Alex starts investing $500 per month on January 1st, 2026. He does not wait for the perfect entry point. He just starts. His friend Mark also wants to invest $500 per month. Mark decides to wait for a 20% market correction before starting. He waits 14 months. The correction comes. He starts in March 2027. Alex started 14 months earlier. At age 65, Alex has $1, $97 million. Mark has $1, $81 million. Mark waited for the perfect moment, and it cost him $165. The best time to invest in an index fund is always right now, not because the market will not drop tomorrow. It might, but because time in the market consistently beats timing the market. Every month you're invested, dividends compound. Every month you wait, they do not. Missing just the 10 best days in the stock market over a 20-year period cuts your return nearly in half. You cannot predict when those 10 days happen. Nobody can. Staying invested through everything is the only way to capture them. Now let me walk you through the specific funds you should know about. Not every index fund is created equal. The difference between a good index fund and an average one comes down to 3 factors: expense ratio, index tracked, fund size, and liquidity. The top S&P 500 index funds for individual investors in 2026 are these: FXAIX from Fidelity, expense ratio of 0.15%, tracks the S&P 500 directly, one of the largest and most liquid funds available, excellent for a Roth IRA or taxable brokerage. VFIAX from Vanguard, expense ratio of 0.04%, also tracks the S&P 500. Vanguard invented index fund investing in 1976. Their funds have a long track record. Minimum investment of $3,000 to start. VOO from Vanguard, the ETF version of VFIAX. Same holdings. Expense ratio of 0.03%. No minimum investment. You can buy one share at current market price. Excellent for those starting with smaller amounts. SPY from State Street, the oldest S&P 500 ETF. Expense ratio of 0.0945%. Extremely liquid. Widely held. Slightly higher fee than VOO or FXAIX. FZROX from Fidelity. Expense ratio of 0%. Tracks the total U.S. market, not just the S&P 500. Holds over 2,500 Washington companies instead of 500. More diversification. 0 fees. Available exclusively inside Fidelity accounts. For total market exposure with maximum diversification and 0 fees, FZROX inside a Fidelity Roth IRA is unmatched. For pure S&P 500 exposure, FXAIX or VOO are the top choices. If you are inside a 401k, Look for the fund with the lowest expense ratio that tracks the S&P 500 or total market. The name matters less than the expense ratio and the index it tracks. Anything below 0. 10% is excellent. Let me also address tax efficiency inside taxable brokerage accounts. Index funds are more tax efficient than actively managed funds in a brokerage account. Active funds buy and sell frequently. Each sale inside the fund triggers a capital gains event. That event gets passed to you as a taxable distribution, even if you never sold your shares. Index funds rarely sell their holdings. The turnover rate for a typical S&P 500 index fund is under 5% annually. An actively managed fund often turns over 80% to 100% of holdings in a year. Each of those sales creates a taxable event for you. The index fund keeps you invested. It keeps your tax bill minimal. It grows largely undisturbed by unnecessary selling inside the fund. This tax efficiency compounds meaningfully over a 20 to 30-year holding period. It is another silent advantage that rarely gets mentioned. Now let me talk about dividends. This is the piece of index fund investing that most beginners underestimate. Every company in the S&P 500 that pays dividends passes those dividends through to fund holders. The S&P 500 currently yields approximately 3% annually in dividends. That does not sound like much. But those dividends get automatically reinvested into more shares. More shares earn more dividends. More dividends buy more shares. This is called dividend reinvestment, and it is one of the silent engines of compound growth. On Alex's $1, $97 million final balance, dividends reinvested over 33 years contributed over $280,000 to the total from a 3% yield that most people dismiss as insignificant. Always ensure dividend reinvestment is turned on inside your brokerage account. It is usually a one-click setting, and it makes a profound difference over decades. Let me also address what happens during market crashes, because this is where most people abandon the strategy. The market drops 30%. The news is terrifying. Experts predict more losses. And the instinct is to sell. Move to cash. Wait for stability. Every time that instinct wins, it costs investors enormous amounts of money. Here is the historical reality. The S&P 500 has experienced 11 bear markets since 1956. A bear market is defined as a drop of 20% or more. The average decline in those bear markets was 35%. The average recovery time back to previous highs was 2 years. After every single crash in history, the market recovered and went on to new highs, every single one. The crash of 1987, the dot-com bust of 2000, the 2008 financial crisis, the 2020 pandemic crash, all of them recovered. All-time highs followed. During those crashes, Alex kept contributing $500 per month. When the market dropped 30%, his $500 bought significantly more shares that then recovered in value and compounded on top. Market crashes are not disasters for long-term index investors. They are sales. Every share you buy during a crash is purchased at a discount. When the market recovers, those discounted shares appreciate fully. Dollar cost averaging, which is what Alex does by contributing the same amount monthly, automatically buys more shares when prices are low and fewer when prices are high. It turns market volatility into a systematic advantage. That is the opposite of what most investors experience. Most investors panic sell at the bottom and buy back at the top. Alex just keeps his automatic investment running. The strategy does the work. Now let me walk you through the math in detail so you see exactly what $500 per month builds. These are real compound interest calculations at a 10% average annual return. At 5 years, $38,000. At 10 years, $102,000. At 15 years, $207,000. At 20 years, $382,000. At 25 years, $663,000. At 30 years, $113 million. At 33 years, $197 million. Look at that progression carefully. The first 10 years produce $102,000. The last 10 years of the same 33-year period produce over $1. $1 million. The final decade produces more than 10 times what the first decade produced. Same contributions, same fund, same return. The only difference is time. This is why starting early is not just good advice, it is mathematically transformative. A 25-year-old investing $500 per month will retire with nearly 3 times the wealth of a 35-year-old investing the same amount. Not twice, 3 times. The math of compound interest accelerates exponentially. The longer the runway, the more dramatic the result. Now, what if $500 per month is not possible for you right now? Let me show you what smaller amounts still build. $200 per month for 33 years at 10% becomes $788,000. $300 per month becomes $1. $18,400,000 per month becomes $1. $57 million. Even $100 per month started at 30s becomes $394,000 by retirement. The amount matters. The start date matters more. Whatever you can contribute right now is the right amount to start with. You can increase it later using auto-escalation inside your 401k or by manually increasing your Roth IRA contribution annually. But the starting point is not $500. The starting point is whatever you have available today, because every month you delay costs you compound interest you cannot recover. Let me now show you the 3-account stack for index fund investing. This is where individual fund selection meets the right account structure. Your index fund investment goes in a specific order across specific accounts. Account 1, your 401k through your employer, contribute at least enough to capture the full employer match. Inside the 401k, select the index fund with the lowest expense ratio, usually an S&P 500 index fund or total market fund. If your plan has a Vanguard option, use it. If Fidelity, use it. Schwab index funds are also excellent. Avoid target date funds if lower cost index funds are available. Target date funds hold a mix of stocks and bonds. They underperform a pure index fund over long time horizons for young investors. Account 2, your Roth IRA, open through Fidelity, Vanguard, or Schwab. Inside the Roth IRA, invest in FZROX, FXAIX, or VOO. All gains and withdrawals are completely tax-free. The combination of index fund growth and Roth IRA tax protection is the most powerful long-term wealth building pairing available to working professionals. Contribute $7,000 per year in 2026. That is $580 per month. Per account 3. If you have additional capital beyond the Roth IRA, add more to your 401k toward the annual $23,500 limit. Then consider a taxable brokerage account at Fidelity or Schwab using the same index fund strategy. In a taxable account, you pay capital gains tax on growth when you sell, but the long-term capital gains rate is 0%, 15%, or 20% depending on your income. Still significantly lower than ordinary income tax rates. And you can hold index funds in a taxable account for decades before selling, deferring that tax indefinitely. Alex uses all 3 accounts. His 401k at work captures the full employer match using an S&P 500 index fund. His Fidelity Roth IRA receives $500 per month invested in FZROX. His auto-escalation inside the 401k increases his contribution 1% per year. Alex does not have a financial advisor. He does not pay management fees. He spends approximately 30 minutes per year reviewing his accounts, and at 65, he has $1, $97 million. From the most boring investment strategy available, one more thing that gets overlooked entirely. International index funds. The S&P 500 captures U.S. companies only. For additional diversification, consider adding a small allocation to a total international index fund. Vanguard's VXUS is the most popular international index ETF. It holds over 7,500 companies across developed and emerging markets. Expense ratio of 8%. Extremely broad diversification. Fidelity's FZILX is the zero-fee international index option. A common allocation for a long-term investor is 80% U.S. total market and 20% international. This gives you exposure to economic growth in Europe, Asia, and emerging markets. When the U.S. market is flat or down, international markets sometimes outperform. Not always, but the diversification smooths the overall ride. Alex keeps 80% of his Roth IRA in FZROX and 20% in FZILX. Both have 0 expense ratios. He captures global economic growth at 0 annual cost. That is the complete index investing setup for a serious long-term investor. There is one final thing worth addressing. People ask whether the S&P 500 will keep delivering those returns going forward. Nobody can guarantee future returns. What history tells us is this: the S&P 500 has recovered from every crash, hit new all-time highs after every bear market, delivered positive returns over every 20-year rolling period since 1926. The U.S. economy is driven by innovation, productivity growth, and population expansion. The companies in the S&P 500 are the largest beneficiaries of that growth. The index is self-cleaning. Failing companies get removed, rising companies get added. It is not a bet on any single company or any single sector. It is a bet that the U.S. economy will be larger in 30 years than it is today. That bet has never been wrong over a multi-decade horizon in the modern era. And if it ever is wrong, no other investment strategy will protect you either. The index fund is the starting point for serious long-term wealth building. Not because it is exciting, because it works. Let me also walk through what a realistic monthly budget looks like for someone starting this strategy. Take someone earning $65,000 per year. Take home after taxes is roughly $4,200 per month. Rent or mortgage takes $1,400. Groceries and food take $500. Transportation takes $400. Utilities and subscriptions take $200. That leaves approximately $1,700 in discretionary income. Contributing $500 per month to a Roth IRA index fund takes roughly 30% of that. It is not nothing. It requires intention. But it does not require a six-figure income or an unusual lifestyle. It requires treating the Roth IRA contribution like a fixed bill, not optional, not something you do with whatever is left over, a fixed automatic transfer that happens before discretionary spending kicks in. This is called paying yourself first. The investment comes out immediately after your paycheck arrives. What remains is your spending budget. You adapt your lifestyle to what remains, not the other way around. The single behavioral shift, treating investment contributions as non-negotiable, is what separates people who build wealth from people who intend to start next month. Alex does not think about whether to contribute this month. The transfer is automatic. It already happened before he checked his balance. He budgets around what is left, not around what he hopes to have left. Set up the automatic investment before the end of this week. Let the system run. Build the habit. The rest follows. Now let me address one final concern that many professionals in their 30s bring up. They feel behind. They look at the compound interest charts and feel like they missed the window. They are 33 or 36 and they have barely started. They wonder whether it is even worth trying at this point. Here's the honest answer. Starting at 33 with $0 saved is significantly better than starting at 43. Starting at 36 is significantly better than starting at 46. You have not missed the window. You are looking at the wrong part of the chart. The last decade of compound interest is always the most powerful. A 36-year-old who starts today and retires at 65 still has 29 years of compound growth ahead. 29 years of the S&P 500 compounding at 10% on every dollar contributed. That is more than enough time to build life-changing wealth. The only version of this story where you definitely lose is the one where you decide it is too late and never start. Do not let a feeling of being behind stop you from starting. Starting imperfectly today beats starting perfectly next year. Alex was not a finance expert when he started. He did not fully understand compound interest when he opened his Roth IRA. He just started contributing. He let time explain the math to him through his growing balance. You can do exactly the same thing. Let me bring everything together now. The S&P 500 Index Fund is the single most reliable wealth-building tool available to ordinary investors. It beats 95% of actively managed funds over 20 years. It carries expense ratios as low as 0% with Fidelity's FZROX. It automatically diversifies across 500 of America's largest companies. It reinvests dividends silently and compounds them over decades. It turns market crashes into buying opportunities through dollar-cost averaging. And it requires almost no time, skill, or financial expertise to use properly. Alex starts at 32. He contributes $500 per month. He never stops. At 65, he has $1, $97 million inside his Roth IRA alone. Kevin picks stocks. He earns an average 8% annual return. He retires with $840,000. The gap between them is $1. $13 million, Alex did less. Alex won. The fund did the work. Here is your action step for today. Log into Fidelity, Vanguard, or Schwab. If you do not have a Roth IRA, open one today. It takes 15 minutes online. Search for FZROX, FXAIX, or VOO inside your account. Set a monthly automatic investment for whatever amount you can start with, even $100 per month, even $200. Turn on dividend reinvestment. Set the contribution to auto deposit on the first of every month. Then leave it completely alone. Do not check it after every headline. Do not sell when the market drops. Do not move it to cash when things feel uncertain. The strategy only works if you stay in it. Every single exit costs. You compound interest you cannot get back. Stay invested. Keep contributing. Let time do the work. Alex is doing exactly that. You can start today. If this video gave you a clearer picture of what to invest in and why, subscribe to Retirement Blueprint. Every week, we break down the exact moves working professionals need to make. Real numbers, real accounts, no fluff. Before you leave, drop a comment right now. Are you currently investing in an index fund, or are you still picking individual stocks? Tell me where you're starting from. I read every single comment on this channel. See you in the next video.